Every single bubble will pop. Sometimes it takes years or even decades, but with complete certainty, we can be rest assured that all bubbles will eventually meet their end. What is interesting is that the bigger the bubble is, the more damage it causes along the way. The ripple effect will be magnified, and the difficulty in restoring the crisis becomes more problematic. But thankfully, there are no bubbles in the global markets today, right? You came here for the truth, so let me unveil that for you. Today we are going to look at the mother of all bubbles. I'm going to show you several charts today, really good ones in fact, and they come from this document here. Crescat Capital has decided to put this out, and I found some good information in it, so I wanted to bring it to you. So thanks to them for providing the charts. We're talking here about what's happening basically in the markets today. They make some suggestions. I don't necessarily agree with what they're saying, but I just want to show you the information, okay? Because you can piece it together for yourself. It's not about me telling you what to do or what to think. This is information. So let's get into it right away. U.S. households and non-profit organizations' financial assets to disposable income. Right here. The mother of all bubbles. Today, bigger than all bubbles before it. We are now over 550%. Before that, we had the China and emerging market crises, the U.S. housing bubble, the global financial crisis, the dot-com bubble, Asian crisis, and so on. We go and look through this and have to see, do we ever learn from our mistakes? Of course, the answer is no. The central banks around the world have a very simple policy, and they applied this policy throughout the Roaring Twenties. And that was make it very easy for individuals to borrow, try to get stimulation to happen, have your different stimulus packages, TARP bailouts, and so on. And the whole quantitative easing is relatively new, but bringing interest rates down has been a practice they've been doing for quite some time. They're trying to make it easy money, right? Well, every time they do this, they always find a way to create a crisis. And so when it's too late, they realize, oops, irrational exuberance. Let's start to bring interest rates up. Oh, it's too late. We've got a big problem. And then what do? Well, you have to bring the rates down even further than they were before. You have to do more stimulation, and you always make the problem worse a few years later. Maybe it's 10 years later. Maybe it's 12 years later. It doesn't matter. Eventually, a lot of people get burned because they have ridiculous policies. So let's see what else we got here. Some good charts today. Macro model shows U.S. stock market record overvalued and overdue for a bear market. So you could see right here it's showing us on this, based on the Crescat macro model, undervalued or overvalued. We're seeing that right now. The same things that we saw during the financial crisis and the dot-com boom. So essentially, this is the S&P index on this side, based on their different way to look at it. All I want to show you is that there's so many different models that break this down that we can look at. Here's the full breakdown here on this side. I'm not going to read it all to you. However, different things like the yield curve, unemployment rate, and so on. Once it meets this criteria, this is actually a really in-depth way to look at it. And today, higher than we ever have been. And so what's important to note from this is that we don't just look at the stock market as an indicator. When somebody looks at the stock market as being an indicator of the health of the economy, we immediately know that there's no way this person has done their homework. Critical divergence between U.S. equity markets and the rest of the world. So this is something I've shown you many times before, but basically we're looking at the all-world index excluding the U.S. versus the rest of the world. This is literally the rest of the world for the most part. And as long as you exclude the U.S., the market head down significantly. I keep hearing this silly meme that stock markets are rising. Well, maybe if you keep it to just the US. Otherwise, that's not the case. That is not the case at all. M2 money velocity breaking out from a multi-decade resistance. So we'll see where this goes right now. It's important to see the velocity of money continuously rising in this scheme that they've set up today. We don't know where it's going to be in the future. All I can tell you is that over the past few decades, in fact, it has been getting worse. And we've seen that velocity slowing down. We have watched as this becomes an issue for the central bankers because they're printing up all this money, but it's not making its way into the economy. And that was their failure, to print up money and somehow have that stimulate the economy. It is absolutely impossible. It has no bearing on the economy whatsoever. Yet, when they said, well, we're going to stop printing money, suddenly that sent a sell signal to the markets. And then, that was 2015. We started seeing that, we're going to reduce the amount of money that we're printing. We're going to taper. This is going to happen soon. We're going to start to increase interest rates. And then, the market started to dip a little bit. But then we had the ECB, the Bank of Japan, the PBOC, and so on say, don't worry, we'll print. And they increased the amount of money that was being printed globally, even though the Federal Reserve stopped printing. Okay, moving on. U.S. stock market cap to GDP at all-time highs right now here in 2018. So this is sometimes known as the Warren Buffett indicator, Wilshire 5000 U.S. total market index to GDP. And what's funny about this is that despite the fact that, first of all, he didn't create the indicator, but this is something that he likes to look at, you can see here, Warren Buffett is buying stock right now, so therefore we shouldn't look at the indicator that he loves. I think it's just foolish to go by necessarily what he's doing and not be, really doing your own due diligence. Well, Warren Buffett bought Apple, therefore I can buy Apple. It's not working like that. Please don't think of it like that. You can buy Apple. There's nothing wrong with buying Apple. There's nothing wrong with buying Amazon. But don't do it because somebody else did, even if that somebody else is Warren Buffett. One measure of market valuation has matched its 2000 level, while another has doubled. S&P 500 median price to sales, and at the blue line, S&P 500 cap weighted price to sales. These are significantly up today, and we can pile on the indicators one after the other. And ultimately, we are overvalued today. It is important to know that. Okay? This right here is showing us the Hussman margin adjusted CAPE. So there's different ways to look at the PE ratios, the cyclically adjusted PE ratio. But here, in this case here, they make some modifications to that. I'll just quickly, margin adjusted CAPE normalizes the denominator of the Shiller CAPE for a variation in its embedded profit margin, and it goes on. Okay, so that's a little adjustment, and in that case, it really shows us that we're worse off than we were in the financial crisis, worse off than we were in the year 2000, and even back in 1929. Fed is still running too, quote, hot to stop inflation. Looking at this here, you can see the Fed funds rate as well as the Crescat interest rate model. And again, they've done some good work here to break it down, whether we're looking at the personal income, the core CPI, oil prices, and so on. This all breaks down to create their own models. And today we are looking very, very hot. That's not good because this could precipitate a crisis in the near future. We'll see what's going to be the thing that breaks the back here. I think that the S&P 500, the Dow Jones, the NASDAQ, they can absolutely continue to hit new highs. I do not think that would be surprising to me at all. What I worry about is at what point does the back get broken and people start to lose everything they have. Because the longer this goes on, the more money will flow into it, the worse it's going to be in the end. That's truly worrisome for me, because I know so many people have put way too much into it in hopes that it will continue to rise forever. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support the channel, so you can help me out there. And if you want the financial education you were not taught in schools, these 2 books have it all. You can check these out at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com. If you're still here, I just wanted to thank you very much for spending your time with me today and listening. I really appreciate all the positive words, the encouragement. Thank you all.